Yeah.
Hello everyone, we are from Group 2. We will introduce ourselves. My name is Leni Duarti.
My name is Maulidia Rahmaputri.
My name is Meshi Rahmawati.
My name is Nadia Guherni Febliana.
And Lala OKTAVIANI.
Today we are talking financial statement, the income statement, the balance sheet, and the cash flow statement.
We're going to try and explain all the basics.
So let's get started.
What are financial statements? Financial statements are reports and summarize the activities and financial performance of a business. They are prepared at the end of each accounting period and they're designed to give investors and lenders a feel for a business's financial health. The three main financial statements are the balance sheet, the income statement, and the cash flow statement. Now, I'll explain how each of these work with an example. Delicious is a family-run business that produces a popular blend of black tea. Their financial year has come to close and they've finished putting together their financial statements. So let's look at them. We'll start with the balance sheet. What is the balance sheet? The balance sheet is a financial statement that gives us a snapshot of a business's assets, liabilities, and equities at a single point in time. The balance sheet is also called the statement of financial position. And it looks like this. In the header, we have the business's name followed by the name of financial statement, and directly below, we have the point in time that we are looking at, a snapshot of December 31st. On the left-hand side of the balance sheet, we have a list of everything the business owns. It's called assets. And on the right, we have everything the business owes, its liabilities and equities. Delicious owes liabilities to third parties like its suppliers, its employees, and the tax office. But it also owes equity back to the owners of the business. This includes their original capital contributions, which is the cash the owners injected into the business, and retained earnings, which are the cumulative profits that the business has held onto.
If we collapse the balance sheet down into its core components, then we can see that Delicious has total equity of $129.5 million. What does this mean? Well, if the business were to suddenly sell off all of its assets and pay off all of its debt, then in theory, this is how much money an owner will get. Off the bottom of the balance sheet, Delicious has total assets of $169 million and total liabilities and equity of $169 million. The stuff it owns is equal to the stuff it owes, so the balance sheet is unbalanced. What is fantastic now because a balance sheet always has to balance. Why? Because its size so in the accounting equation. Assets are always equal liabilities plus equity, or the stuff that a business owns is equal to the stuff that a business owes.
What is an income statement? An income statement is a financial statement that summarizes a business revenue and expenses over a period of time. If the balance sheet is a snapshot of a point in time, then the income statement is more like a video or boomerang covering a range of time. The income statement look like this. As you can see in the header, the income statement covers a period of time. The year ended December 31st. And in the body of the report, we have a summary of revenue earned and expenses incurred. If we collapse it, that we find in the income statement is really showing us three things. Firstly, Delicious made $255 million in revenue, which is their top line count that is earned from selling products during the year. Secondly, it incurred $248 million in expenses. This includes the direct and indirect costs of running the business. And finally, when we subtract expenses from revenue, we see that Delicious generated $7 million in net profit on the bottom line. Profitability is key to the income statement, which is why it's also called the statement or profit and loss. It tells us how much profit the business earned over a period of time. But be careful here because profit doesn't necessarily translate to cash flow, which is why business also need a cash flow statement.
Cash flow statement. A cash flow statement is a financial statement that shows a business's cash inflows and outflows over a period of time. Businesses need to make a cash flow statement if they are using accrual accounting. There are two methods of accounting. We have the cash method and the accrual method. The cash method of accounting is often used by smaller businesses. It says that revenue is recognized when cash is received and expenses are recorded when cash is paid out. Under the cash method, the income statement and the cash flow statement are equivalent to one another. If cash comes in, we record revenue, and if cash goes out, we record an expense. What if Delicious makes a large sale, but the customer doesn't pay the invoice until the following accounting period? Their revenue could be understated in the period that they made the sale and overstated in the following period when they received the cash. The accrual method says that we should recognize revenue as it's earned and record expenses as they are incurred. When the substance of the transactions take place, this means that cash inflows and outflows are equivalent to revenues and expenses. They need to be tracked separately in the cash flow statement. A cash flow statement looks like this. In the header, we have the period of time that is related to, just like we had in the income statement. And in the body, we have two main sections. At the bottom, we have the opening and closing cash balances for the financial year. We get these numbers from the balance sheet. Delicious started out with $11 million and finished up with $12 million. So overall, that's a net increase in cash of $1 million. But how did this come about? This is where the top section comes in. We work out the cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So the first one is cash flow from operating activities. Cash flow from operating activities covers regular business activities. How much cash Delicious brought in a span while selling tea? Delicious is using the direct method. So this section mirrors an income statement prepared under the cash method of accounting. The second one is cash flow from investing activities. Cash flow from investing activities looks outside of the core operation of the business. There are the cash inflow and outflows from investment and buying or selling property and equipment. The third one is cash flow from financing activities. Cash flow from financing activities is all about funding the business either through loans from banks or equity from the owners of the business. The owners of the business. If we collapse this all down, then the net cash flow on the top should match up with the net cash flow on the bottom. It does here, which means the cash flow statement is reconciled.
Financial statements are two or more lists that are systematically compiled at a certain period and addition the necessary record. Financial statement consists of a balance sheet. Is list is compiled systematically so that it can provide an overview of the financial position in the current period that is dependent on asset, debt, and capital. The balance sheet and can be arranged in the form of two income statement. Income statement is list that describe the amount of income and expenses. The difference between income and expenses is called profit or loss. And cash flow statement, the capital change report is the list that shows the amount of capital of an enterprise and the end of the accounting period or the end of the year. This report contains the amount of initial capital, profit or loss, as well as the owner take or profit or dividend. And then the balance sheet. The balance sheet gives us a snapshot of a business asset, liability, and equity. At a single point in time, it shows us what the business owns and what is owed. It all tells us how much the business is worth to its owners. And income statement. And then we have the income statement, which shows us business revenue and expense over a period of time. When we take the difference, we can see if it made a profit or a loss. Financial cash flow statement. The cash flow statement reflects a business cash inflow and outflows over a period of time. These are considered back to the movement in cash the balance sheet.
Thank you for attention. See you next time. Bye.